Welcome back. Now let's look at the IAS number 16, property, plant, equipment, or the PP&E. So property is what we're referring to as the land and building. The plant is the factory, and the equipment is the computer and other equipment that we use in our production processes or perhaps for administrative purposes. Now, for the recognition criteria under the IAS number 16, recognition, which means we're going to debit the PP&E. So we're going to recognize the PP&E onto the SFP, or the Statement of Financial Position, is when the property, plant, equipment is probable that the future inflows will be in the business. So for example, we're going to be using the PP&E to generate future economic benefit by producing a product and to sell it. Alternatively, another inflow would be the reduction in costs if I were to use the PP&E. And the expenses can be reliably measured, so which means we're going to spend the money out, we've got the invoice already, so we can recognise that PP&E at that particular value. And of course, very importantly, the PP&E should be held for use, so either for production processes or perhaps for administrative purposes. And in terms of materiality principle in the IFRS, for the small PP&E in practice, so usually the business may set a criteria, any value of the PP&E less than $5,000 will not be capitalised, and it will be different from entities to entities. So in other words, for larger PP&E, we need to capitalise it on the SFP rather than recognising it into the expense, into the P&L. And for complex asset, so for example, you may have heard of the plane, for example, the aircraft. We've got different elements in there. So that's why we need to depreciate each of the PP&E separately. So for example, the engine will be depreciated over, for example, the straight line method over 20 years. And table and chairs, we're going to depreciate them over, for example, 30 years and something like that. And in the IAS number 16, if there's anything related to safety and environmental reasons, we're going to spend the money out. So for example, we're going to plant for example, for environmental reason, so we need to plant some trees next to our factory. So we incur $1 million to build the factory, and we incur $0.1 million to building and planting those trees, and that $0.1 million also needs to be capitalised as PP&E, because that's for safety and environmental reason per the laws and regulation in your country. So how about for the initial measurements? So for example, what values are we going to put onto that PP&E? Again, same as what we've seen in inventories, we need to capitalise it, or we need to recognise it or measure it at historical cost. So which means it's the money that you're going to spend in buying that PP&E, including the purchase price and non-refundable taxes. So for example, the import duty needs to be capitalised. And also some of the direct costs. So for example, the site preparation. So for example, we're going to get rid of the existing stuff. So for example, existing facility, we incur $0.2 million there. So it will be the site preparation costs that needs to be capitalised as part of the PP&E. Transportation costs into delivering the item from the seller's office or the seller's factory into our factory. And that transportation cost, or we can call it as the carriage inwards, needs to be capitalised as well. Also handling costs, as what we see in the inventories. We need to get that PP&E outside the warehouse or outside our factory to our factory inside. That cost we're going to incur in, for example, renting a special machine to deliver that item. So that cost needs to be capitalised as well. And also installation costs in making sure that the equipment can be in the current situation or current condition for the business to use. That installation cost needs to be capitalised. Professional fees, so for example, the lawyers drawing the contract, the fees that are going to pay to the lawyer, and also other costs related to, for example, for a building, the architecture design costs that needs to be capitalized as well. And also staff costs that we incur in employing specific staff in installing the machine for us and so on, that needs to be capitalized. And also test costs to test the equipment, so you're going to input some materials in there, and before it can be finally confirmed that we accept the equipment that we purchased. So the raw material costs that we incur in testing that equipment, whether or not it's up to a particular standard, that needs to be capitalized as well. But remember, if that materials that you're going to input into the equipment and it turned into a final product, the final product, we're going to sell it. So in other words, we're going to net off the net realizable value. So in other words, we input $10 for raw material costs, but after it's been turned into a finished product, we can sell it for $4. So the net amount of $6 that needs to be capitalized. And also any of the dismantling costs, very importantly, if you're building an oil rig, or perhaps you are in the mining industry, so you've got a mine in there, and if this is the case, then according to perhaps the laws and regulations in your jurisdiction, you'll have to dismantle it at the end of the 20th year. In other words, the future cost that we need to discount it into today's terms and to recognize the PP&E and to capitalize it. So we debit the PP&E for the future costs, discounting it into today's terms, and we credit to increase our provision liability today. Okay, so that's all we can do. And for provision liability, that should be regulated according to the IAS number 37, provisions contingent liabilities, a contingent asset. We need to fulfill certain criteria, including the probable cash outflow, present obligation, and also the expenses can be reliably estimated. And subsequently, for provision liability, we need to recognize the finance costs by debiting the finance cost each and every year, and to credit the increased present value of the provision liability. Okay. So these are what I mean by capital expenditure. So for the capital expenditure, so all we can do is to recognize it as part of the PP&E at cost. For revenue expenditure, on the other hand, we simply expense that into the statement of profit or loss in terms of training expenses, admin expenses, for example, the expenses we're going to pay to our staff regarding their salaries and so on. The initial operating losses before we launch the factory, before we launch our shop, so we may discount our products, we may give our products for free, and these costs that needs to be expensed rather than being capitalized as PP&E. And startup costs, for example, the costs that you obtain the license for you to set up your company instead of buying the PP&E, that set of costs that needs to be expensed. And also the maintenance and repair expenses that needs to be expensed. These are called revenue expenditure. We debit the expense into the P&L rather than debiting the PP&E at cost. So that's the initial measurement. So for example, the initial measurement is $1,000 for a PP&E. But how about for a subsequent measurement then? Well, accounting policy, we've got a choice here. Either we're going to choose the cost model, which means we're going to carry $1,000 as the PP&E at cost and to minus the accumulated depreciation. Either we depreciate it using the straight line method or the reducing balance method, or perhaps we're going to use the revaluation model. In other words, if you purchase the land and buildings, the valuation may change, and that's why you engage with the independent external valuer to put a value on that according to the market price changes. And therefore, for revaluation model then, so it would be applied to certain items of PP&E. But in the business, it would classify the PP&E into the property category, plant category, and equipment category. For each category, you can use different accounting policy. So for example, for the equipment, in most circumstances, we will use the cost model. For the property, in some circumstances, we may use the revaluation model and something like that. Also for subsequent measurements, for any subsequent major overhaul costs, so overhaul costs, which means the major inspection costs. In certain industries, for example, for the airline industries, the aircraft needs to be subject to inspection for every few years. And these costs will be quite high, and these costs can be capitalized. But also in some jurisdictions, for example, in China, for example, according to the laws and regulation in China, for major overhaul costs, it has a definition. So for example, you spend $1,000 to purchase the item of PP&E. If that overhaul costs does not account for more than 50% of 1,000, which means not higher than $500, it will not be meeting with the definition of the major overhaul costs and needs to be expensed, because we're going to treat that as simply the inspection expenses. So it would really depend on which jurisdictions you're in, so to define the major overhaul costs to be capitalized. If you're using the revaluation model, so the revaluation upwards, we're going to put that into reserve, which means the OCI of the comprehensive income in the statement of profit or loss and OCI, and accumulate that into a reserve into the SFP. Another area in the IAS 16 is the retirement and derecognition. So retirement, which means we're going to temporarily put the asset into idle condition. We're not using that right now, for example, for a period of 6 months. But during that 6 months, we still need to depreciate it. So one of the examples I can give you for the retirement in a practical situation is where the government may have a policy. So for example, in China, the government has a policy in the past to abandon some of the mining companies to operate, and therefore the equipment that they are currently using will be put into idle condition and therefore to retire the asset. But subsequently, the equipment can be used again after this period is gone. So in this period, still, these businesses still need to depreciate these equipment. But for the derecognition, on the other hand, which means we're going to sell the asset, will result in the gains and losses from the sale. And the gains and losses, put that into the P&L. Because when we sell the asset, we simply increase to debit bank and to credit the PP&E at carrying value, which means to credit PP&E at cost, debit accumulated depreciation, and the balancing figure will go into the P&L. Or in practical terms, of course, we create the disposal account, and the balancing figure in the disposal account would simply be the gains and losses from the disposal. And the previous OCI, if you're using the revaluation model, you've got the previous revaluation reserve. When we derecognize the asset, we're going to transfer that reserve into retained earnings by reducing or debiting the revaluation reserve and to increase and to credit the retained earnings. So to make sure that the previous revaluation reserve would account for the real return for the business if the business has disposed of the item of PP&E, and it will not affect the dividends going to be paid to those shareholders. The disclosure requirements in the IAS 16, first of all, you need to disclose the accounting policies. For example, either you use the cost model or revaluation model. You need to disclose the accounting estimates relating to the depreciation issues, relating to the number of years that the PP&E can be used for, and the residual value or the estimated residual value that the PP&E has. And also you need to disclose different classes of asset in terms of property category, in terms of the plant category, and in terms of the equipment category. That's very important now. For depreciation accounting, as I said before, according to IAS number 16, two major depreciation methods that we can use would be the straight line method and the reducing balance method. And of course, there are some other depreciation method that's available in different parts of the country that can also be recognized and acceptable from the IAS number 16's point of view. How about for residual value then? In depreciating the asset, the business, of course, when buying the asset and subsequently at the end of each reporting period, it will need to estimate that residual value if that residual value is material. So in terms of certain assets, for example, the factory, in terms of the aircraft, in terms of the higher value assets, the residual value should be high. And we can reasonably estimate or assume the residual value is available there. And therefore, you need to update that residual value for, I would say, frequently. So perhaps some businesses may review that for every 1 year, but some businesses may review that for every 6 months and something like that. It really depends on which jurisdiction and industries that you're working in and the companies that you're working for, and that's different from companies to companies. So that's all we have. Now, next accounting standards, IAS number 19, employees benefit. So employee benefit, what do I mean by that? Is the expense that you're going to pay to the employee, we simply debit expense and to credit bank. If you haven't paid for that, we credit the accrued expense. And in the exam in particular, we are very interested in the pension plan. So which means when the staff gets retired, it's the money we're going to pay to that staff. So the pension plan can be divided into the defined contribution or the defined benefit. So the difference between these two would be this. So here's the company, and here is their staff. And the company would say to the staff, when you retire, you will get $5 million. So the $5 million benefit will be defined or fixed or promised by the company. If this is the case then, that's the second type of the pension plan, which means the DB scheme. The DB scheme is the defined benefit scheme. So usually in practice, the company will not manage that pension asset portfolio by itself, but the company will engage with an external trust company. And to put this money into a trust company and signing a contract with the trust company, and the trust company would use this money to invest in buying shares, buying bonds in different ways, and to grow that asset up, so hopefully it will have return to pay to its staff when staff are retired. But therefore, as you can see here, because the companies promised their staff to get this $5 million, and therefore the company should recognize the pension asset as well as the liability in the financial statements, even though the money has been transferred to a trust company. And for a pension asset, it will recognize the interest income each and every year. For a pension liability, it will recognize the interest expense, because all we are saying here is we are using the current market terms, or you can call it the present value terms. And therefore, according to the amortized cost model, we would have the additional interest expense as well as the additional interest incomes to be recognized in the P&L by the company. And additional service costs, if the staff are retired, the service costs that needs to be incurred, and also service costs can form part of the accruals concept to match the benefits they're using the staff to generate future economic benefits with the costs that they incur. Okay, so it's according to the matching principle. So what the company should do then is to calculate the value of the pension assets was the liability, and the trust company will also calculate the value of the pension asset as well as the pension liability. The difference between these two would go into the OCI, or you can call it the reserve in the SFP. We call it as the remeasurement component, okay, or in the past we call it as the actuarial gains losses. So what do I mean by actuarial gains losses is that because the company in the DB scheme that we promise staff that the staff will get certain amounts of money when they retire. And this is why we transfer the money into a trust company, but at the same time, we also need to employ an actuary to make sure that the value is calculated. So the actuary will calculate the asset value and the liability value from the trust company's perspective, and therefore it becomes the actual pension asset as well as the pension liability amount in our company's statement of financial position. But if the company does not promise the staff when you retire how much money do you will get, if the company doesn't promise that, it will fall into the defined contribution category or the defined contribution plan. So what we can do when we transfer the money into a trustee, into a trust company, we simply recognise the expense and to credit the accrued expense liability in each and every year, and that's how we do it. Okay. Now, another accounting standard is the IAS number 20, government grant and disclosure of government assistance. So what do I mean by government grant is where the government give you something, so usually in the form of cash. So there'll be two types of grants here. So the grant, which means help from the government. The government may help you out with regards to your capital because you buy or you acquired a piece of non-current asset, for example, PP&E. And therefore, the government gives you cash to help you with that. Alternatively, you've incurred a certain expenditure. So for example, the marketing expenditure, salary costs and so on, and the government decides to help you out by giving you cash for reimbursement. And this is called the revenue grant. So in practice, all we could do is we obtain, so for example, $1 million or $100 from the government, for example, and we need to separate that into the capital and revenue grant element. So for example, $70 would be related to capital and $30 related to revenue. That's the first step that we usually do in practice. Second, if the government decides to give you some certificate itself does not have material value. So in other words, these are non-monetary grants. So give you certain, for example, the green certificate, you can resell those green certificates to third parties to gain profit. If this is the case then, according to the IAS number 20, you've got two choices here. It's your accounting policy. You can either recognise those certificates that were received from the government at notional amount, usually $1, or at fair value. So in other words, you're going to benchmark according to the market prices of those green certificate of how much money or net proceeds that you can get. You can recognise those certificates as your fair value and bringing that to your inventory in your SFP. So, with regards to grants, the first type is the capital grant, which means you acquire, for example, the building and government give you some money. So under the IAS number 20, we've got two methods here. We've got the deduction method, we've got the deferred income method. Under the deduction method, so for example, you acquired a piece of equipment at $200, but government helps you by giving $10. Because that $10 is related to the piece of equipment that you bought. That piece of equipment is an example of non-current asset, and that's $10 would be the capital grant. So when you receive that capital grant of $10, you simply to debit bank of $10 because you received the money from the government, and to reduce the PP&E costs by $10. So why this would be a case is because that we spend $200 out, but the net spend would be $190, because we spend $200, but we get reimbursement of $10 from the government. And therefore, the net cost to my business is just to be $190. Because when we acquire the equipment at $200, we debit PP&E costs by $200 and credit bank by $200. So by using the first method, by netting the PP&E costs against that 200, subsequently we will have less depreciation expenses in each and every year. The second method is the deferred income method. So all we can do is we debit bank of $10 of the capital grant, and we put that into deferred income liability. Okay, so that's all we can do. And subsequently, we're going to release that deferred income liability into the actual income, into the P&L to increase our profit up according to the life of the asset. So for example, if we bought that piece of equipment at $200, we debit PP&E at cost of $200, and we credit bank of $200. And subsequently, if we were to depreciate that over 10 years, we will debit depreciation expense by taking that PP&E at cost 200 divided into 10 years. That will be $20, and to credit accumulated depreciation, we can call it as the PP&E at carrying value of $20. When receiving that $10, we debit bank of 10. We put that into a deferred income liability, into a statement of financial position by 10. But subsequently, we'll release that deferred income liability over the next 10 years in each and every year by releasing $1 into the P&L. So by debiting to reduce the deferred income liability by 10 divided into 10 years, $1, and to credit the income into the P&L by $1. So to match the expense that we incur when we acquire the asset subsequently, according to the matching principle. So this way is the deferred income method. But for a second type of grant, which means the revenue grant, so all we can do, because we receive the money from the government to help you to reimburse some of the expenditures that you incur in terms of marketing, R&D, and in terms of the salary costs. So we will receive money from the government with debit bank, and simply to credit the income directly if there's no conditions there. So for example, I can give you $10, no conditions set by the government. But if there are any conditions set by the government, so for example, I will give you $10. Yes, I've given you $10 already, but you will need to repay me that $10 if you don't fulfill this criteria. For example, I will give you $10, or I've given you $10, and if the $10 finally belongs to you, if the, for example, satisfaction rates in your business and the level of employment targets can be met, okay, and the number of staff that you can recruit it, and that $10 would finally belong to you. And if there are any deferred income liability for subsequent measurements, all we can do is doing the same thing, to debit the deferred income liability, so for example, according to the number of years, according to the condition, and to credit the income. Or when you finally meet that particular target, you can release that to income into the P&L. How about for repayment? So which means you don't fulfill the conditions set by the government, and you need to repay the money back. And for the revenue grant, you simply remove the additional or the remaining deferred income liability to credit bank to repay that money, and for the balancing figure, we put that into the P&L as a loss, in other words. Because it's just to be, we need to repay $10 and we recognize that $4 already. But the deferred income or the additional income staker I can recognize in the future will be 6, but total 6, but I need to pay 10, so I suffer $4 of losses. In other words, the previous income, so I can recognize, I have already recognized, will not be an income any longer. For a capital grant, on the other hand, it's just to be the same, to reduce the deferred income liability and to reduce the bank, and the balancing figure, we put that into the P&L. And finally, for the government assistance, so the government may give you some assistance. So for example, the media coverage, or appointing the staff, assigning the staff from government to your office and to assist you doing some job relating to marketing, related to R&D and so on. So the government does not directly give you cash. If this is the case, then that form falls into the category of government assistance. For the government assistance, you need to disclose it. No journal entries are required, but you need to disclose that. You need to disclose that fact in the financial statements in your annual report, and that's very important there. Okay, I'm going to stop here for the IAS number 20, and I look forward to seeing you to cover the next accounting standard in the next of our section then. Bye.
APC, accounting for your future.